Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, May 31st, and then we'll see how things look for Thursday, June 1st. We had a bit of a pullback. Not a lot of damage was done. We're turning more negative in the short term. Now we have to see, is this going to continue? Is the overall picture going to turn more negative? Or is this just a pullback before we get set to go higher? On a positive side, we've worked off all those extreme positive readings, so the market isn't really going up too far too fast based on Wednesday's action. Before I get started, please know that I do have a supplemental video that's posted. It's about 3 weeks old now, but it's still very relevant to what's happening right now. I do have a PDF of all the slides and charts that are available for you to download and you can follow along. I also have a private Facebook group that you're welcome to join. I do have a poll that's posted this week that you're welcome to take part in. And I do post videos also on Rumble. If you can't find me on YouTube, look for me on Rumble. And then yesterday I talked about an article by Chris Schiff. It's pretty interesting, and I have a link down in the description for today's video. All right, let's go back and talk about what happened. We did have a gap lower open, and prices fell down to S1 at 41.88. Then we quickly fell down to S2 at 41.71. As the day went on, prices found support around that S2 level. We were able to rise back up to S1, but then we closed down below S1. So we were down 0.61% on above average volume. It really spiked up. The technicals have switched more negative in the short term. We're still hanging in there with the intermediate term, but we could be seeing some signs of weakness. We also have a lot of this negative backdrop that I've been talking about in the videos. The debt ceiling issue, my understanding is an agreement has been passed through the House. Now it has to go through the Senate. That might give some relief to the market. And then we still wonder, are we going to get any more banking information? What are some comments that we can make? The uncertainty still is there about the passage of the debt ceiling. As I said, they still have the Senate that needs to approve this. Cleveland Fed President Mester came out, who's not a voter, and said she sees no compelling reason to pause the rate hikes. Governor Jefferson, during his speech yesterday, said that he thinks that skipping a rate hike at the coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. Then Philadelphia Fed President Harker came out, who is a voter, and said that he thinks the Fed can take a bit of a skip for a meeting. Fed officials continue to imply that further rate hikes could happen after the June meeting. So even if they pause at the upcoming meeting, it doesn't mean that they're stopping. The S&P did fall back down below 4,200. All of the short-term indicators are no longer extreme positive. In the intermediate term, we do have the Sean trend meter. The dollar was up and interest rates were down. And we still have all of our yield curves that we follow remain inverted. Sentiment remains unchanged at 62, so we're still positive overall. In our trend, it's still positive, but now the green line is coming down with the declining day. The ADX is still above its moving average, but it's rolling over a bit. Both of them are below 20. Our bias is now negative with the down day, and I've kept our momentum at mixed. The economic reports that came out, we had the weekly MBA mortgage applications index. It was down 3.7% overall. Last week, it was down 4.6%. Purchase applications were down 3% and refinancing was down 7%. The Chicago PMI came in at 40.4. They had expected it to come in at 46.1. Last time it was at 48.6. It's still below 50, so that's showing contraction. The JOLTS job openings came in at 10.103 million, up from the 9.745 million that we saw last time. Looking at some Isabel Net charts, first we have bubbles for the few, bears for the many. This is what they call the America's Magnificent Seven. When we looked at a chart the other day from Edward Yardeni, he calls it the Great Eight. So take your pick. But it just shows how these stocks are doing better than all of the other stocks are right now. And this includes Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. Then looking at the monthly seasonality, we tend to be fairly good in June. Not the best month, but not the worst month. We're up 65.2% of the time with an average gain of 2.13%. Then the NASDAQ 100 futures are really long right now. It says leveraged funds, which could be like juiced ETFs or enhanced mutual funds. And then asset managers are very net long in NASDAQ 100 futures. And that's what we're seeing with these green lines going up. That could be negative since everybody is starting to jump in. Here's the latest SLOOS reading showing that tightening standards continue to go up across banks. And then small caps, they remain historically cheap when you compare them to large caps. The Russell 2000, we look at a chart of that each day. The Russell 1000 is the large caps, showing how the small cap stocks are becoming quite cheap in relation to large cap stocks. That could bring in some positive buying into the market if people think that they're getting a bargain. Then this is another chart that we look at each week in the weekly video. This is the smooth U.S. recession probabilities. We're still below this black line. When we really start to get nervous is when we go above this red line, and we're still comfortably away from that. But this chart doesn't update all that quickly. A couple of Twitter charts that I ran across from Mark Ungewitter. Okay, I have no idea if I said that right or not. He's looking at both sides here. He says a normal cycle advance, if that's what's brewing, might carry the S&P to 5,400 to 5,600. We're just about in the trend channel, which is what we've been watching. That could take us all the way up above this level. But if we fail, that could take us all the way down to 3,300. Then he looks at the 200-day breadth momentum above 50% would support the bull case. We're still below down here on the bottom. We need this to turn and go back up to be more positive. And then this was kind of interesting. Tom McClellan posted this. You can just read this and see if it gives you a chuckle. Then looking at our analysis, first the intraday chart where we did gap lower down at S1. We quickly went down to S2. We did find support at this level. We tried to come back up. We made it back up to S1, fell back, came back up again, and then saw some selling going into the close. The intraday chart, we were pretty much flat in the initial overnight session. Then we started to go negative. Then we saw the negative open with the rebound, and we're showing a little bit of improvement in the initial overnight session. Looking at large cap growth versus value, growth did underperform value with the large caps, but they did better with the mid caps and a little bit better with the small caps. And here's the chart showing how growth is still doing better than value overall. Here's the ratio between the two. The last few trading days, it's been pretty flat, but when we look at the mid caps and small caps, it's still improving. Looking at sentiment, the Ulcer Index still is suggesting there's not a lot of fear. With the down day, the VIX did tick up on the line chart as well as the bar chart. The VIX of the VIX continues to fall, showing that volatility is decreasing for the VIX. And then we're keeping an eye on this. This is the correlation between the VIX and the S&P. This is continuing to go up. We get excited about this when it goes above this dashed line. We're not there yet. And then looking at the MOVE index, bonds were up, so this ticked down slightly. Stocks were down, so the VIX ticked up. The ratio is shown here in green, where the S&P is in red, and the correlation is still quite strong. Looking at the SKU index, we are seeing this going up. We're not up to this extreme red area yet. Looking at this fear gauge, we still are declining overall. We're pretty much sideways to slightly up with this other fear gauge. Then we're still favoring more of a risk-on posture. It fell back a little bit in Wednesday's session, but overall this is turning back up. Advanced decline line, pretty much chopping sideways with our 5 period to slightly down, and we're flat with our 10 period. We're declining based on price, but still above the moving average. We're still below the moving average based on volume. Accumulation distribution is still above the moving average, even though it declined. The advanced decline ratio continues to be below 0. That's more negative. And we're still seeing negative divergences with the cumulative advanced decline line and the regular advanced decline line. And the NYSE advanced decline line continues to be below this upward sloping trend line. We're also seeing a longer-term negative divergence when we look at common stock. And then our broader range study, the NYSE showing weakness, as is the S&P, and the mid caps and the small caps continue to show more weakness. Looking at our trend with the ADX, we're still above the moving average, but we're rolling over a bit. However, both are still below 20. The green line is on top, but it is declining. And then our shorter term ADX shows that we're trying to build up some kind of a short-term trend here. The green line is also on top, but declining. Volume continues to pick up. And then in the short term, here's our daily chart where we're just coming back down after hitting resistance. Then you can see on the bottom where volume just really picked up. The Stochk RSI is no longer extreme. Same thing is true with the Williams percent R, the CCI 14, and the CCI 20. We're still above the 20-period moving average study here. So that remains somewhat positive. But with this decline, we're getting a lot closer. Now this chart still suggests that we're turning more negative. We've fallen below the double and triple exponential 20-period moving averages. Our short-term stochastic is no longer extreme. We're still doing okay with the intermediate term, but we're declining with the longer-term stochastic. The force index is still above zero, but has declined. Intermediate term charts, balance of power continues to be below the dashed line and is declining. We're right in between the double and triple exponential moving average, which may end up providing some kind of support if we continue to fall. The go-no-go system still remains positive with the darker blue bar. The TTM squeeze is still hanging in there and looking positive. The PPO still looking good with the long and intermediate term. We're still above zero in the short term. Our Rune indicator is pretty much flat, but it's still positive overall. We're still seeing this negative divergence with the S&P McClellan oscillator, and it's below zero and dropping back down. Here's the NYSE McClellan oscillator below zero and also declining. The summation index, we've fallen below zero based on price. We're pretty much chopping sideways right now based on volume. And here's our NYSE summation index where we're showing a decline based on price as well as volume. The Elder Impulse system has switched to neutral. Our PMO study, we're just a little bit above the moving average with the PMO. We're still declining based on price. We're going sideways based on volume. We did see a decline with the PMOs that are rising, but we're not extreme negative. Also a decline with the buy signals, and we continue to decline with the PMOs that are above zero. The Swenlin trading oscillator turned up just a little bit. That could be potentially positive, but we're still below zero. We were pretty much flat based on volume. The parabolic SAR still remains positive, and we're still above the 50-period moving averages. And we're above all the moving averages in the moving average tree. The slope is still positive, but rolling over a bit. The MACD is also still positive, and we're looking at our longer-term oscillators here where we're pretty much flat with the tricks as well as the KST. The Sean trend meter still kind of near the upper end of being extreme positive, even though it's fallen back. And the BPI is below 50 and declining. That's negative. The NYSE BPI is also below 50 and declining. The Chaikin money flow is still positive, but also declining. The Chaikin oscillator still above the dash line, but declining. Money flow, which had been going up, is now dropped back down below 50. That's negative. The ultimate oscillator still above 50, but declining. The vortex, the green line's on top, but it is declining. On balance volume, we're coming right back down to the moving average, so that's more neutral. And then longer term, we're seeing this divergence when we look at the 200-day moving averages and the 50-period moving averages inside the S&P. The Copic curve still remains on a buy signal, and the Pring bottom fisher also generated a recent buy signal. Our Fibonacci lines, we're still above this 4170 level. We're just 9 points above it now. Will this provide some kind of support? Also, if we continue to fall, we're looking at 4123, which is about 55 or 56 points away from current price. That may provide some support. Longer term, if we fall, we're still above this 4156 level. We're about 23 points away from that. Longer term, if we really start to fall, we're looking at 4020. We're still above all of the plotted moving averages when we look at the open, high, low, and close. This may have provided some kind of support. We're coming back into the downward sloping trend channel. We're wondering, once we bumped into this area, are we going to turn and go in the other direction? Our different charts, the Heikin Ashi has turned a bit more negative. The Kegi chart is still positive but pointing down. And the Renko chart remains positive. Three-line break also remains positive. Looking at our indexes, the equal weight still continues to underperform the S&P. And we're still seeing longer-term negative divergences when we compare the Dow and the transports, and a shorter-term divergence when looking at utilities. Our new take on Dow theory, we're just barely above this breakout line with the S&P. We did break out on the NASDAQ, but the NASDAQ is now pulling back slightly. The transports continue to underperform the Dow. The big stocks continue to outperform the smaller stocks. The Dow is still above its 200-day moving average, but has not been able to get above its 50-period moving average. The diamonds remain neutral. The NASDAQ, after really going up and closing near the bottom part of yesterday's low, is that some kind of a reversal that we're getting ready to see? When we look at the NASDAQ, we're still seeing the cumulative highs minus the lows really trail off. And when we compare the new highs minus the new lows, we continue to be negative. The NASDAQ came up to this 50% retracement level. Is that going to provide overhead resistance, and are we going to turn and go down? The NASDAQ 100 also closed near the low yesterday and now is showing a bit more of a retreat. The Elder Impulse system has switched to neutral for the Qs. We did get above the 61.8% retracement level, but then we fell back after that. Longer term, we're still positive when we go back to the all-time high. The BPI for the NASDAQ 100 did decline slightly, but it's pretty much going sideways. Small caps continue to show weakness. The RSI for the Russell 2000 has dropped below 50, and the MACD it's still positive but rolling over. The small caps have turned to negative for the Elder's Impulse system, and small caps continue to really underperform the S&P 500. But this is where we're seeing pockets of strength. When you compare small cap growth with small cap value, we were up yesterday, even though the index has been declining. With the mid caps, we're still below the 200-day moving average. And the mid-caps for the Elder Impulse system have switched to negative. But we're seeing continued growth and almost like a breakout going on here. So there are pockets of strength inside the market. The home builders, with the S&P declining, the home builders also declined. The ratio declined. The relationship is still pretty strong. Keeping an eye on the financial sector, we were down over 1%, continue to be in a downtrend. The financials are underperforming the S&P. And the regional banking ETF is now starting to go back down compared to the financial sector. Looking at bonds where interest rates were down and bond prices were up. Then we look at our S&P 500 against the long-term bond, where the longer-term correlation is not as strong as it usually is. Shorter term, it's getting a little stronger, but the spread between the two is still pretty strong. And we're also keeping an eye on this. This is the 3-month yield, and it's exceeded where it was at back before the great financial crisis. And we're wondering, is this some kind of warning? Our long-term analysis, we're still below the red line with the special K. And then we're still hanging in there with the weekly chart where the MACD is still going up, suggesting that this breakout above the trend line is legitimate. But the further we get away from that, the less relevant that becomes. An update of our possible positive scenarios. We're below zero based on price when we look at our 19-day exponential moving average of the advanced decline ratio. And we've also dropped slightly below zero based on volume. But when you look at the Qs to the S&P, that's still strong. Discretionary is not really doing all that well, but large cap growth is outperforming large cap value. We compare the large caps doing well, mid caps well, small caps, a little bit of an improvement. This is also positive, even though it dropped back a little bit. The ratio between the S&P and the utilities still shows that the S&P is outperforming. But when you look at the broad measure of the market, we're still below zero when we take the new highs and subtract the new lows. But this is still hanging in there overall. We turn back up when you compare growth with value, and we've really been going up since the beginning of February. Longer term, we're starting to come back down with our 50-period exponential moving average of the new highs minus the new lows, but we're still positive. Our indicator has now dropped below zero, and if it stays there longer, it'll bring that red line down with it. The 2-year Treasury yield, after spiking up and coming back down, now it's starting to go back up again, although it was down in Wednesday's session. And this is looking more positive too, but we're not seeing any real follow-through with price action. The ratio from the staples to S&P 500, it's really falling off now. So what's our outlook for Thursday? We're still dealing with earnings season. The technicals are turning more negative, and we still have a lot of those underlying negatives that I've been talking about, as well as negative divergences. We have the ADP employment change report coming out, the weekly jobless claims, the first quarter productivity revised, as well as unit labor costs. the IHS Market Manufacturing PMI, and the big one will be the ISM Manufacturing Index, followed up by construction spending. Geopolitical events. Right now, it's pretty much about the debt ceiling, and then anything else on this list can easily come flying in at any time. Here's the outlook for the rest of the week. We're on Thursday right now, showing all of the economic reports. The big report is going to be on Friday. That's the employment situation report. Then the speeches are pretty much done now for this week. They were all given on Wednesday. And then the Stock Traders Almanac statistics. This is new for June, so I'm going to go through this a little bit. It says the summer rally is the weakest rally when you look at all four seasons. It's up 9.4% when it does have a rally. Over 59 years, winter does the best, being up 13%, followed by spring, 11.8%. And in the fall, we have 11%. One thing that is noticed is watch out for the end of quarter portfolio pumping on the last day. That'll come at the last trading day of the month. During pre-election years, we tend to have a return of 1.5%. Now, looking at June 1st, we're positive, pretty positive for the Dow and the S&P, where we're more neutral to positive with the NASDAQ. And we tend to be up 55% of the time and down about 44% of the time for the month as a whole. And then going back over our yearly statistics, we do have a 3.0 score with our trifecta. We had the Santa Claus rally, the first 5 trading days, and then the January barometer. That gave us a score of 3.0. When that happens, the market is up 87.1% of the time with an average gain of 12.3%. When you take all 12 months, it's up 90.3% of the time with an average gain of 17.5%. And the markets also like that we are split between Republican and Democrat within Congress. Looking at a chart updated by Dan Bird, where it's just showing the best 8 months go into July. But then we have the 2011 comparison when the debt ceiling last had to be really dealt with. We're right about at this level. After the debt ceiling deal came out, we did see some weakness with a bounce back and then some really strong weakness in late July going into August. Schiff Capital chart is pretty much showing that same thing. Then looking at the pre-election year, that's the green line where we're coming into a pretty good time of the year. This also is suggesting the gray line that we're looking a little more positive. So what about our scenarios? Hard to go with the down one yet, even though we had a down day. We haven't really switched over negative yet, even though the technicals are weakening and we have a lot of these negatives. We need to see more follow through based on price. Also difficult to go with the up one because we're just not trending right now. So we still default to the sideways or neutral trend. The ADX is still above its moving average, but both of them are below 20. We are positive with the green line on top, but it is now declining. Some warning signs. We still have a lot of negative divergences that I went through. There are numerous signs of weakness that are coming out in the market right now. The VIX is still showing a lot of complacency. The NYSE advanced decline line, it's still below that upward sloping trend line. And the NASDAQ cumulative new highs and new lows are showing weakness. The small cap index is underperforming, and the mid cap index is also underperforming and has recently generated a death cross. Earnings season continues, could be positive or negative, and we should be getting to the end here pretty quick. What are the positive things? We still have a buy signal from the Copic curve as well as the Pring bottom fisher. Our longer term seasonality and setups, those are still there and they're positive. Our posturing has switched back to risk on. Lower price levels may provide some support if we do start to fall. The S&P continues to outperform utilities. The NASDAQ and NASDAQ 100, they're still breaking out even though they pulled back on Wednesday. And the Staples to S&P 500 ratio is declining overall. Small and mid-cap growth that I showed on those charts is still showing strength. And will a resolution to the debt ceiling crisis, will that give us a short-term rally? Right before I started recording, I checked the futures and we're up slightly where we had been down. Or is this going to be a sell the news type of reaction? So our conclusion, the S&P, it's weakening and we have a lot of negatives that we have to deal with. In the short term, we've really switched back more to negative, even though we're slightly above the 20-period moving average. We're turning more negative in the intermediate term, but there's still some positive things there too. But long term, we still remain positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.